Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's dig a little deeper into that labor data we got today. We're joined by Joanie Bily, Chief Workforce Analyst she's also the chair of the American Staffing Association. So we appreciate chatting with Joanie every time we get these jobs numbers. Joanie, what do you make of this number? The print right across the surface looks really solid.
Yes. Well, hello, Paul and Emily. Great to be with you today. Really interesting report this morning. The headline number looks very strong, over 250,000. And it's interesting listening to Austin Goolsbee talk about, the numbers and how this might relieve, a lot of pressure. But I have a little bit of a different take when you dig into these numbers. Most of the jobs that were actually created in the month of September were in the healthcare sector and then also in the leisure and hospitality sector. Those two sectors alone had about 160,000 jobs created. So then if you dig into the details here, we can see, construction was good, 25,000 jobs created. The government added 31,000 jobs, but then we're not seeing robust growth in many of the other sectors. And so I think that headline number can be a bit misleading when you look at the actual data that is in the establishment survey.
So what then is it telling you about the current state of the U.S. economy when you do seem to have noticed this kind of maybe distorted picture of the labor market, at least just looking at the numbers and the data that we got this morning?
Yes, I think there are some sectors that are doing well. I'd like to see growth come back, in the manufacturing sector, stronger numbers in the professional and business service sector. We still saw a decline in September of almost 14,000 jobs in the temporary help staffing sector. And that's something that I always pay attention to because it's part of the industry that I'm in. So Emily, I think what it's telling me is that we're still in a soft job market, though some of these indicators look good. And I do believe, Austin did mention it. There are other indicators that are showing we're still in that soft job market. Maybe we've gotten to a point where we do have that soft landing and things will start to improve over the next few months. And I certainly hope that that is the case. But I don't think that we are out of the woods just yet.
So that's a more cautious take than we've heard throughout the morning here, Joanie, just in terms of this market, as you characterize the labor market as maybe a little bit softer than it appears here. What are people missing, do you think?
Well, I think if you look at the report, and seeing almost 80,000 jobs come back in leisure and hospitality, those jobs are lower leveled skilled jobs and lower wage positions. So what we're not seeing come back yet are the higher skilled, more professional positions. Certainly in the healthcare sector, that remains very strong, but we're not seeing jobs like in accounting and finance and really that STEM field, which there is a strong, demand in the future for, the skilled jobs in science and engineering, but we're not seeing a ton of job creation in those sectors right now. I also was very surprised that when you look at, some of the numbers in like transportation and warehousing, those numbers were very soft, which tells me we're going into the retail season. We're not seeing, the companies really get ready for a strong, retail holiday season. We're also seeing, employers that normally hire this time, of the year and start to ramp up for the holidays, their projections are a bit softer of the amount of people that they are going to need. So that's where I think I take a little bit more of a cautious approach. I'm not saying that we're going to fall off a cliff by any means, but we still need a few more months of job growth and really start to see some of that growth come from other sectors, in addition to healthcare and leisure and hospitality.
All right, Joanie, thank you so much for joining us. We really appreciate getting your perspective when we try to break down some of these jobs numbers here today. Joanie Bily, she's a division president at Employbridge, and she's also the chair of the American Staffing Association. So a great voice to speak with on these important jobs days.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Again, on the labor front, the print here, as Lisa was just reporting, very strong jobless claims or print for the non-farm payrolls today, much better than expected. Some good unemployment rate numbers as well. Let's check on Ben Emons because we want to see what this means for the Federal Reserve. Ben Emons is the founder and chief investment officer of FedWatch Advisors, joining us from Washington, D.C. So, Ben, again, a strong labor number today, non-farm payrolls. How do you think this Federal Reserve is going to interpret this data?
Hi, Paul. Well, listening to Austin Goolsbee, he does continue to indicate there are more cuts coming, right? I think they feel that although these could be sometimes outliers on a monthly basis, it's interesting it still happens because of the pandemic effect with all this distortion in the household versus establishment survey. It's nonetheless a labor market that does show deterioration. Like if you look at the median duration of unemployment, it has now risen to 22 weeks. That's the highest since, I think, 2022. And if you take, the percentage of people, of 27 weeks or longer out of work, that's now at 23% of total employed. So there's some underlying deterioration. I think this Fed is keen on bringing that back in and trying to control for the worsening of the picture, given the restrictive stance. So I think the Fed will continue to look at this saying, we have room to cut. This is a good labor market, but we can cut rates because we just have very restrictive policy to keep the labor market in good shape.
I'm wondering if, a lot of people talk about how monetary policy happens and comes with a lag, and yet we're only about a month after the first rate cut. So, Ben, would you say that the rate cut is already working, or is something else also driving the strength in the labor market right now?
So I think it's partly the signaling effect from rate cuts. If you step back, actually going to the June-July period when all that softness started to come through and the Fed speakers started to also look at that and start to talk about rate cuts, all that signaling happened. If you now look at the ISM data that's coming through now, including regional data, you see in all the forward-looking indicators some sort of a turn upwards, right? And that's new orders and inventories and that sort of like cyclical indicators. And again, it brings me back each time to Bostic, who was so outspoken on this, saying that they, in their surveys with local businesses, they got a lot of feedback like, okay, Fed, if you're going to cut rates, we're going to see a lot more sales activity, a lot of things happening. And I think that may be a reason, right? So in surveys, it shows up, whereas this employment report itself, I was talking to your economist, Anna Wong, about this. Like there's some alternative data out there that indicated that may have been a really strong month. But it could be because of just a lot of shifts happening underneath. So I think the basis points of cuts that we just had, that is just hitting the economy as we speak. But that may take some time for it truly works through. Why this Fed, I think, is not deterred cutting rates from here, despite the strong number. But the signaling of cuts is interesting. That is coming through the forward-looking indicators. Yeah.
Hey, Ben, we kind of came into this morning with a reasonable likelihood that 50 basis points was on the table for the next meeting. I'm looking at the WERP function here, and that seems to be kind of off the table, seems to be pricing in a 25 basis point cut at the November meeting. How do you expect the Federal Reserve to proceed over the next 3, 4, 5 meetings as we get into next year?
Yeah, these probabilities are so fluctuating, Paul. Like I looked at that too. It was 30% before the number, now dropped to 7.5% for 50 basis point cut. So it is definitely sensitive to anything that's stronger of data, right, versus weaker of data. I think that's the mechanics of the markets. So the Fed will ultimately come down to back what they did in at this meeting. We'll get this minutes out in a couple of weeks. I think they just continue to look at like where the policy is in broader sense of how restrictive it really is. And look, since the last two CPI reports, PCE reports, the real interest rate, the Fed funds rate, has only risen a little further from here, right? So it's gotten even more room to cut rates. We get CPI on Wednesday, I believe. It's probably going to be not as strong of a CPI data either. So that real Fed funds rate remains quite high, drifting towards 3%. I think that is what they're looking at to say we can take some off. So we'll keep cutting rates until at some point inflation does show some stabilization, maybe turning higher. And you're seeing the economy really accelerating in terms of growth.
What does that mean for investing in bonds? I mean, today I'm looking at, the 2-year up 15.8 basis points, the 10-year up 10 basis points. I guess those expectations that maybe the Fed is not going to cut as much, is that bad for people trying to make money in bonds here?
It could be because, like that when we were at roughly the lows on the 10-year, was somewhere like 365 or so a few weeks ago, and we're now almost back to 4%, right? So call it 35 basis points of change. The interest rate sensitivity of bonds is still really high. I noted from the index duration, right, so sensitivity of interest rates, has climbed up again since we had this decline from interest rates from the spring, from April all the way into the summer. And so it does show that if you're getting a little move in rates higher, you immediately get these accruing losses. So be mindful of this volatility that's basically caused by this interest rate sensitivity. The short end of the yield curve will always remain a bit more attractive because the yield curve is slowly normalized, but not as much. But there's still much more yield there. That's been said a lot, but I think I stay on that view too. But bonds in itself will remain basically at the whim of this data movement. So there's volatility in bonds that's higher than what we had pre-pandemic, which makes it not always that easy to just go all in bonds. In that sense, I would be more careful with long duration bonds here.
All right, Ben, thanks so much for joining us. Always appreciate getting a few minutes of your time. Ben Emons, Chief Investment Officer and founder at Fed Watch Advisors.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Again, the story of the day, one of the economic stories of the day is certainly that jobs number already came in really strong, the non-farm payroll here. So let's break it down with somebody who does this stuff for a living, Tom Gimbel. He's a founder and board member of LaSalle Network. LaSalle was founded in 1998, and it is one of the leading staffing and recruiting firms in the country. So this is Tom's business. Hey, Tom, you guys put up, being the labor market, a pretty strong data point here today. What do you make of it?
Well, I think number one, I went to the UVA of the Rockies, University of Colorado.
There you go.
If we can get a go Buffs real quick. But
you bet, go Buffs, go Buffs.
There we go. Listen, this report is, if you're anything but optimistic after this report, you're crazy. This is an unbelievable number with unemployment dropping and higher than expected jobs numbers. And it's a really good sign for the economy.
So what do you make, Tom? Where is some of this demand coming from? There are a lot of people that want to maybe poke a little bit of throw some shade on this and say it's coming from leisure, it's coming from healthcare, and not really the higher paying jobs. How do you when you go underneath the surface? What's it look like?
Yeah, I think I always find that interesting, right? So they would rather not have people being hired in hospitality and leisure and construction. Like it's the fact that we have consumer spending that happens at hotels and restaurants and service industries means that consumers are making more money and they have more disposable income, which is a positive sign for the economy. So that hiring is really good. And what'll end up happening is that continues to fuel it, that if people are spending more, than the companies that make those retail products will be hiring more people at those companies, and so on and so forth. And without getting too Reagan-esque, but it's trickle-down economics. And you're going to have a situation where it keeps fueling better employment numbers, which is exactly what we want to have happen. Now, the one soft spot I continue to see is in recent college grads. I'm not seeing the volume of hiring at people coming right out of college a year out as I have during other bull markets, but I think that'll change post the election.
From your neck of the woods, how much are people actually talking about the Federal Reserve and the impact of rate cuts on the labor market? Because obviously at Bloomberg, we are just obsessed with every,
Sure.
Piece of data that comes out and what it means for the Fed. But, how much do you actually talk about it at LaSalle Network?
Oh, I think that whether it's LaSalle Network or the CEOs and CFOs and heads of HR that I talk to on a regular basis, the Fed rate is really important to people. And I would say more on mid and large cap companies, because they're looking at the cash flow, the borrowing rate, how they're going to be able to hire people, how their wages affect their bottom line. And so I think it's a really important indicator that people look, even if people don't understand exactly what the Fed rate means, they do get that when rates were really low, there was nothing stopping hiring in the economy and what's going on. So when companies see that the Fed's dropping rates by 50 basis points, people get excited. Now, the biggest difference, and I've been preaching this with you guys and elsewhere for a long time, is that we have more employers in this country now than ever before. And what I mean by that is, if you would have gone back 60, 70 years ago, if somebody lost their job at Ford or General Motors, they were car people. They could only get jobs if the car industry, rebounded. Today, skills are so transferable due to technology. And while I think it's not going to last forever, but remote work, that you can lose your job in Detroit and be working for a company in Silicon Valley as well. And so we have that opportunity. And then the startup nature that companies and individuals can raise venture money and startups, that I don't think we're ever going to have an employment lag like we had in the 70s really ever again.
Tom, I guess I haven't asked you this in a while, but where are we on that whole remote work? Have we settled into a new normal? And I guess that's company by company, 3 days, 4 days, 5 days. Where do you think it is these days?
Yeah, I think right now it's 3 days. I still see, it still amazes me, Paul, how many CEOs are afraid. They'll talk to me, they'll talk to each other, and they'll say, God, we got to get people in, but they won't lead. They won't say it. And that to me is really the disturbing part. I think the Amazon statement last week was really powerful, and you'll start to see some follow the leader type statements coming out. I think where we're going to get to is 4 days a week, and some companies going 5 and some going 3, but the average will be 4. And come 2025, we're not going to remote work and people wanting that isn't going to happen. And you're going to see when companies start to downsize, and that will happen. And other companies will hire them, so it won't affect the numbers. But when you see companies lay people off, it's going to be the remote workers that get hit first.
Just going back to the print that we saw this morning, hourly earnings rose 4% from a year ago, the biggest advance in 4 months. I'm wondering what you make of this upside surprise in wages and what that tells you about the strength of the labor market.
Well, I think it's interesting, and I have to dive a little bit deeper into the hourly wage increase, and I saw that as well. But it really comes down to, you have more people working more hours, and in the retail space, it's so hard. I mean, listen, I'm in Chicago. I was in New York a few weeks ago. I was in Nashville last week. It's really, when you go to a restaurant, the service is lacking because there aren't enough people. And I talk to the managers when I'm there to find out on the ground what's happening. And I think what you're seeing when you see hourly wages increasing, it's because you can't find the people. And so you got to pay a little bit more to make sure that your people stay. And if you find somebody, that you're getting the best that you can get.
Tom, you mentioned just about college graduates still having a tough time. Why do you think that is?
I think because usually what happens with kids out of college, and I'm not talking about accounting degrees or pre-law or whatever, but more liberal arts education, the massive state colleges and people coming out, is that companies hire in volume, whether it's sales or marketing, or they're going to do a training class and all of that type of thing. And when you hear the skies falling every day from both sides of the political spectrum during an election year, companies put the brakes on massive hiring at individual companies. So we're seeing sporadic hiring and small, medium-sized business hiring, but we haven't seen the huge uptake of late stage venture companies, private equity companies that are really pouring money into hiring in mass. And that's the biggest difference I see versus 2001 and 2018, 2019, when the market was really on fire.
We only have about a minute left, but what's the outlook here for job growth for the rest of the year, particularly when you take into consideration the hurricanes in the southern United States?
Yeah, well, I think that's an interesting one, and I'm sure you'll have a lot of people talking about it. My take on it is you're actually going to see a lot of additional employment in the Southeast because we need people to do the work to clean it up. And the companies that do that, whether it's the government or private industry, don't have enough bodies. So you're going to see a lot of hiring going on down there. And the companies that employ the people who can't get to work, those people aren't going to be fired, most likely, and not being filing unemployment. So I think we'll actually maybe see a spike in the October jobs report coming out that first Friday in November due to the hurricane, that we'll have a mass of people going to work in the Southeast to help that situation.
All right, Tom, thanks so much for joining us. As always, love talking to you on Jobs Day. Tom Gimbel, he's a founder and board member of LaSalle Network, giving us a breakdown there. Obviously, he's taking a very positive take on those strong jobs numbers. And again, I'm glad you pointed out, Emily, the wage number, because that's been strong, and it's been higher than inflation for the last almost 2 years now. So the real income for most Americans after that very difficult time coming during the pandemic has actually been quite positive real income. So that's vis-a-vis inflation.
Yeah.
Purchasing power there. So that is good news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Emily Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, and are streaming live on that internet thing. So go over to youtube.com and search Bloomberg Live Radio, and that's where you'll find the video portion of this program. I mean, again, as Charlie just reporting, a very strong print there on the payroll data. Stocks higher, although they're off their highs of the day. Yields moving higher, particularly on the short end of the curve, where we've got the 2-year up 19 basis points. Wow. How about that, kids? 3.89%. The 10-year, we're on a 4% watch here, 3.96%. Let's talk to somebody who actually gets paid to do this stuff. Brian Levitt, Global Market Strategist for Invesco, doing the Zoom thing from the home office. Good for him. Brian, what do you make of this print, and how does it maybe change or alter or your view of kind of where your clients should be putting money these days?
It's a strong number. These things will get revised, so we do take it with a little bit of a grain of salt, but it's a strong payroll number, and I view that as a good thing. It's investors had been so focused on inflation. The shift really is now towards the sustainability, the resilience of growth. And so when you get a strong number like this, it's a positive. Now, the markets took it very favorably initially. As you mentioned, some of those gains have come back. That's because interest rates have jumped up a lot. But I still view it as, if you're in an environment where you have resilient growth and less rate cuts, that's still better than weak growth and more rate cuts.
So, Brian, is it fair to say then that the Fed has engineered a soft landing when you look at how the stock market is reacting and also just how strong the payroll print was today?
Well, that's the preponderance of evidence suggests a soft landing. Now, I don't think we can be absolutely certain yet. There's still some weakness. I mean, if you notice in that report, in the payroll report, the manufacturing sector did lose jobs. We've seen some of the purchasing manager indices sitting below 50 for a bit here. But yeah, I mean, the preponderance of evidence still suggests a soft landing and a good backdrop for investors.
So, Brian, if it is continue to be a risk-on environment, how much risk? Stocks, bonds, credit, treasuries? How do you think about it?
Yeah, so we've been in an environment now where the leading indicators of the economy have actually been pointing to below trend growth, and we needed easing. And so easing comes along and the economy's actually been more resilient. Then yeah, you want to be in stocks. You want to be in riskier credit. You want to be in, if you expect growth to pick up, you want to be in cyclicals and value. So it's a broadening picture. If you get the soft landing, as we suspect we will, you should see broader markets than we saw last year. And again, a good backdrop for risk taking.
What does broader mean? I'm thinking about an ETF housed at your very own shop, RSP, that plays, of course, on the equal weight S&P 500. Is that where you kind of see the gains for the rest of the year, or is it better to kind of stay in the market cap, the big tech?
Yeah, equal weight's a great point. So market cap can have long periods of outperformance. It tends to shift towards the end of a cycle when you're going into a recession and coming out. That's when equal weight tends to do well. Now, we've been in this long environment of market cap outperformance. Can we do it with a soft landing? Rather than see a shift with the market cap outperformance coming with a recession, more along the lines of a soft landing and then a reacceleration in activity. That would be my view. We're starting to see it in some places. Small cap, again, having a very good day today on the expectation of this economy's in good shape. So, yeah, a lot of the reason why the market cap outperformed last year is the market priced in a small cap rally or an equal weight rally in 2 months at the end of 23, and then we had to back out all the rate cuts. I don't think that's the case this time. The Fed is likely to continue to lower rates. So long as the economy remains resilient, then yeah, equal weight should outperform.
Brian, you're a global market strategist. So how do you think about the U.S. versus rest of the world?
It's a little bit of a challenge here in the short term because the dollar strength. And, what you would want to see is U.S. growth differentials moving back towards the rest of the world, U.S. interest rate differentials moving back towards the rest of the world. Today's report threw a little bit of a challenge to that because U.S. growth continues to look quite good and interest rates may remain higher than many had thought. And the dollar's moving up pretty significantly. So that's a little bit of a headwind to capital flowing around the world. Now, you play this out over the next few years. The Fed goes through its easing cycle and rates starts to come down. Rates do come down. The dollar should weaken some, but in the short term here, this is a report that's more favorable for U.S. assets.
Okay, so we did stocks, we did FX, we have to do bonds as well, Paul. So, Brian, I mean, we're seeing a really large spike up in yields today in the U.S. How are people making money in bonds?
Well, remember in 2019, investors were begging for 4%, and so it's back again today. In 2019, the answer to the question, how do you get 4%, was, well, lend money to the Russian government. And a lot of people weren't willing to do that. So today, you can lend money to U.S. corporates, the U.S. Treasury, to U.S. municipalities, and get these nice yields. Now, the total return story may be a little bit behind us. But the yields are there for the taking. And, if you're sitting in money markets, remember, those yields will likely come down over time. So there is reinvestment risk. So it's still a very good opportunity for income investors to lock in the types of yields that they were begging for 5 years ago.
Brian, your offices, are they down in the World Financial Center?
They are. So
that begs a question as a Jersey guy. Ferry or path?
It's the path.
Oh, man. There's a cost-conscious guy there because the ferry's a lot more expensive. But it's
fun.
I
mean, it is. When you live in New Jersey, though, you get on you park at the first station you can, and for me, that's Harrison. There's no way I'm driving all the way to the water.
Very good. All right, Brian, we got that down. Brian Levitt, global market strategist at Invesco. He is a path guy. Good to know. You can talk to these Jersey guys when they work downtown. You got to figure out how they get across the river. I, on the other hand, was a ferry guy because it's because and then every night at home we took a car home.
It's
we
a
worked
lot of
till-
fun.
Yeah.
I often
But
take
it's
the
way more
ferry
expensive.
it is more expensive if
Yep.
you go from Manhattan to Brooklyn.
Yes.
But I just like to romanticize my life a little
Well, I'll
bit.
tell you, the ferry, now they live down the Jersey Shore, the ferry down to the Highlands where John Tucker lives, that is a good voyage there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, so we had a good news story on the labor front today. We also had some good news last evening, also on the labor market. We've got the U.S. dock workers agreeing to go back to work as talks extended into January. So that's a good thing for those folks. It's a good thing for the U.S. economy. Let's break it down and see what it really means here. We can do that with Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence, joining us from Princeton. So, Lee, what did the shippers and the dock workers, what did they actually agree to last night?
Well, they agreed to go back to work and go back to the negotiating tables. So, they're going to go back to work until an agreement is made. The new deadline now is mid-January. So, that's obviously on our radar, much like how this last deadline of September 30th was on our radar. And so what that means is that they're going back to work. It's going to take some time to clean up the mess at the ports because there was a backup. Roughly speaking, it takes about a week to clear congestion created by one day of a strike. So call it 3 to 4 weeks until things, quote unquote, get back to normal. And my guess is that the unions, when they do go back to work, they're not going to be going at full throttle. They might be kind of dragging their feet, if you will. So the supply chains are getting back to normal, and hopefully the two sides can come to an agreement where, truly the efficiencies and the throughput is returned to where it should be.
What do we know so far about why the workers actually decided to end the strike?
The why, that's a great question. I don't, I'm not, in those meetings, but my guess is that both sides are being pressured significantly by the Biden administration. The Biden administration said that they did not want to enact the Taft-Hartley Act, which pretty much tells the two parties that they got to go back to the negotiating table and cool off for 80 days. They didn't want to do that because obviously the Biden administration wants to be considered a pro-union president. And then on the other side, Biden administration also doesn't want to see anything to hurt this fragile economy that we're currently in. Growth is expected 1% to 2%, some tepid growth, but it's growth nonetheless. And obviously a prolonged strike could impact those growth numbers. But I don't think it's going to have much of an impact on overall GDP, maybe delaying some things. And on freight rates, you're seeing some of the marine shipping names like Maersk. They're down mid-single digits in trading. And that's really being driven by the fact that if there was a prolonged strike, rates would have probably been bouncing higher. And what we see now is that maybe they're not going to get that bounce. They're still a lot higher than they were last year, but they're still not going to get that extra boost created by the congestion and issues from a labor strike on the East and Gulf Coast ports.
Lee, it sounds like, there's a couple issues there between the two parties. One is just wages, and presumably that is something that you can bridge the gap and get something done. The other one is productivity and modernization and bringing technology here that would threaten jobs. That seems to be a lot harder to deal with. Any sense of how far away they are or how close they may be?
On the money side, from the last numbers that we saw, the union has been very vocal, wanting 77% increase over 6 years, which is roughly a little under 10% a year. And then, the ports came back at around, they upped it from 40% to 50%. I'm assuming they're going to get closer to that 77% over time. The automation is probably a lot more sticky. The ports do want to have more automation. And automation isn't necessarily, a robot comes in and takes out a job. It just might be a different job. And there are ports where workers are not necessarily, there's one in New York, one of the ports within the port system in New York and New Jersey, where they have some automation where there's people kind of operating joysticks, if you will, in an office, and they kind of take control the last couple minutes or the first couple minutes of moving something to ensure its safety. It's not only a productivity standpoint, but also obviously the less people you have on the port, the safer it is. Accidents do happen. And so, I don't know where they're going to come out on this, but obviously the ports want to be more efficient,
Yep.
and the union wants to save jobs. And they just need to figure out, some sort of middle ground, because at the end of the day, there's great technologies out there, whether it's, letting trucks in and out of the port a lot quicker. And that's not only good for port throughput, but it's also good for, if you want to take an environmental standpoint, you don't have a queue of trucks a mile long waiting to cut into the port.
Get into the Port Authority of New York. All right, I got you. Lee, great stuff as always. Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence, giving us the latest. U.S. dock workers go back to work as talks extended to January. That is good news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's talk about electric vehicles. And when you talk about electric vehicles, I feel like you got to talk about tariffs, because it seems like everybody's slapping tariffs on everybody else's EVs, particularly the ones coming out of China. The EU, the latest, the EU announces that they are imposed some tariffs of up to 45% on Chinese electric vehicles. How big of a deal is this for that market? David Welch joins us, Bloomberg Detroit Bureau Chief. So if I'm a Chinese EV, am I welcome anywhere on this planet outside of China? What's going on there, David?
So far, they've had growth in Brazil, not just EVs, but Chinese car makers in general, and the Brazilian government hasn't hit them yet. But, look, the Chinese benefited greatly from American, Japanese, Korean, European companies going to their market, and we split the profits with them. We gave them our technology, and, now a lot is happening that's squeezing out all those foreign interlopers. And they have tons of excess capacity in China. We're talking tens of millions of vehicles in excess capacity. Wow. And they don't want to lay Chinese workers off. The governments there are willing to absorb some losses, but they want to turn the country into a giant export base. That, of course, would be at the expense of everybody making and selling vehicles in the U.S., in Europe, Southeast Asia, where Toyota does a lot of business. So, everybody feels threatened by this. The Chinese government subsidizes its companies in other ways, like free land, paying for factories, funding R&D, and the governments, local and national, own some of these companies, and they're willing to absorb losses while they all go for market share. They're getting subsidies in every way possible, and the foreign governments are saying enough is enough here, and we're not going to just give our car market away to a Chinese export giant.
So why is the EU voting to impose these tariffs now? Bring us up to speed in kind of the context here and the relationship between the EU and China.
Yeah, well, the EU years ago decided diesel wasn't their thing for clean air, and they really pushed for adoption of EVs. And the Chinese seized on that, and they've been growing a lot of market share in all the different European markets within the EU. And that does hurt the domestic companies. Interestingly, with this vote, Germany voted against it, which I thought was kind of fascinating in the sense that this sounds like a very tactical vote by the Germans, because they probably knew that there'd be enough votes to implement the tariff. By voting against it, they signaled to China that they're open for business, and they need that because Volkswagen, Mercedes, and BMW are big players in the Chinese market, and they don't want to be penalized there for what the EU governments are doing.
Interesting. So if I am a Western automaker, whether it's Volkswagen or Ford, David, how do I think about the Chinese market? Is that an opportunity for me, or is that more of a risk here?
Look, it's going away.
Okay.
I think it's a matter of time before the Western companies are mostly squeezed out. You have two factors at play. One is the Chinese product, the domestic product's very good. So it's tough to compete there. They have a cost advantage because of the subsidies, but also because labor is cheap. Arguably, Western companies enjoy some of that, which is cheap labor, but they don't necessarily benefit from all the government subsidies and money for factories, money for R&D, and so forth. But the Chinese government is increasingly pressuring people to buy domestic, and the product is good. So you're seeing market share losses from everybody. GM's market share is down by a third. Volkswagen's taken a hit. Hyundai's down like 80% because there was tension between the South Korean government and China's government in the South China Sea a couple of years ago. And then suddenly nobody wanted to buy Hyundais and Kias in China. So you see a lot of these domestic pressures in China against foreign nameplates. And it's just tougher and tougher for everyone to do business there.
All right, David, thanks so much for joining us. Always appreciate getting your reporting and your perspective. David Welch, he's a Detroit Bureau Chief for Bloomberg News. Again, kind of some concerted effort on the part of some of these Western countries in the form of tariffs against Chinese electric vehicles, a competitive market to be sure, and a developing story to be sure.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.